In the next 10 minutes, I'm going to walk you through 10 investment mistakes that could cost you everything. We'll cover risky moves from penny stocks to real estate syndications, and by the end, you'll know exactly what red flags to look for in any investment opportunity. Picture this. You've spent years saving up, dreaming of financial freedom. Then, in a blink of an eye, it's all gone. That's the harsh reality for many who fall into the bad investment trap. It's easier than you might think to get caught up in the hype of a too-good-to-be-true opportunity. Now that we've set the stage, let's dive into what I like to call the Hall of Investment Shame. These are the financial traps that have burned countless investors, and trust me, you don't want to be next. First up, we've got penny stocks. These might sound tempting. I mean, who doesn't want to buy a ton of shares for just a few bucks? But here's the catch. Penny stocks are incredibly volatile and risky. The SEC defines them as stocks trading under $5 per share, and while you might think you're getting a bargain, you're more likely setting yourself up for a major loss. Why? Well, it's almost impossible to verify if a penny stock will actually increase in value. Plus, many of these stocks are involved in scams. You might wake up one day to find the company doesn't even exist anymore. Talk about a nightmare scenario for your portfolio. Next on our list of shame are obscure cryptocurrencies. Now, I know what you're thinking, but haven't some people made millions with crypto? Sure, established currencies like Bitcoin and Ethereum have seen growth, but we're not talking about those. We're talking about the thousands of unknown, unproven digital currencies out there. These obscure cryptos are often part of pump and dump schemes. Here's how it works. Someone buys a bunch of a low-value cryptocurrency, hypes it up on social media, watches the price skyrocket, then sells everything, leaving other investors holding the bag when the price crashes. It's a modern take on an old scam, and it can wipe out your savings in the blink of an eye. Last but not least, in our Hall of Shame are Forex trading and binary options. These might sound sophisticated, but in reality, they're more like gambling than investing. Forex involves betting on currency exchange rates, while binary options are essentially guessing if an asset's price will go up or down. Both of these investments are incredibly risky. It's nearly impossible for the average person to accurately predict currency movements or asset prices. You might as well be flipping a coin, except in this case you're flipping your life savings. The bottom line? These high-risk, low-reward options are dangerous for average investors like you and me. They're volatile, easy to manipulate, and can lead to massive losses. Stay tuned as we dig deeper into how to spot these risky investments before they spot you. Now that we've covered some of the riskiest investments out there, let's talk about something that might surprise you. There are some investments that seem safe on the surface, but can actually be wolves in sheep's clothing. These are the kind of financial moves that might sound good at first, but can seriously hurt your wealth-building goals in the long run. I'm talking about things like annuities, whole life insurance, and even collectibles. These investments often get pitched as safe bets or smart ways to diversify, but the reality is quite different. Let's break them down one by one. First up, annuities. These are financial products that can seem like a great way to secure your retirement income. You pay in either a lump sum or regular payments, and in return, you get payments back over time, usually during retirement. Sounds good, right? Well, not so fast. The problem with annuities is that they often come with hidden fees and restrictions that can really eat into your returns. As one expert put it, annuities are an insurance product rather than an investment, so the company who's giving you the annuity is going to win more often than they lose. In other words, these products are designed to benefit the insurance company more than you. Next, let's talk about whole life insurance. Now, I'm not saying all life insurance is bad. Term life insurance can be a smart move for many people, but whole life insurance, that's a different story. Whole life insurance policies are often marketed as a two-for-one deal, life insurance plus an investment. But here's the thing. They're usually way more expensive than term life insurance, and the returns on the investment portion are pretty disappointing. As one financial expert bluntly stated, whole life insurance just isn't an efficient use of your money. Finally, let's talk about collectibles. I'm talking about things like rare stamps, comic books, or even fine art. These can be fun hobbies, but as investments, they're incredibly unpredictable. The The value of collectibles is tied to popularity and nostalgia, which makes them really hard to forecast. As one expert pointed out, the problem with collectibles is that it's incredibly difficult to predict what future collectors are going to value. You might think that mint condition Batman comic is going to fund your retirement, but there's no guarantee it'll be worth anything in 20 years. We've covered some risky investments, but how can you spot them before they drain your bank account? Let's talk about the red flags that scream bad investment and some cautionary tales that'll make you think twice before jumping into the next hot deal. First up, pressure to buy quickly. If someone's pushing you to invest right now, no questions asked, that's a major warning sign. As Bankrate points out, high-flying stocks can turn around just as quickly, leaving you with way less than you invested. Remember, a good investment opportunity doesn't disappear overnight. Next, be wary of promises of guaranteed high returns. Bankrate warns, suppose someone tells you an investment has guaranteed returns of a certain percentage, or they say it carries no risk. This person is either dishonest or they don't know enough about the investment. In the world of investing, there's no such thing as a sure thing. Another red flag is lack of transparency or understanding. If you can't explain how an investment works to a friend, it's probably not a good idea to put your money into it. Bankrate notes, some investments might seem attractive, if a bit opaque or difficult to understand. Crypto and other alternative investments may not be a bad choice if you know what you're doing, but if you don't, it's best to steer clear. Now, let's look at some real-life examples of investments gone wrong. Remember the dot-com bubble? It gave us some classic cautionary tales. Take pets.com, for instance. They had a famous mascot and even ran a Super Bowl ad. Sounds great, right? Well, they ended up losing $50 million because their business model included selling items below cost. Ouch. Or how about Webvan? This online grocery delivery company raised $800 million in its IPO. Impressive, but they went bankrupt within 2 years due to massive startup costs and lack of business. That's $800 million down the drain. Even successful investors make mistakes. Warren Buffett, the Oracle of Omaha himself, lost $1 billion on ConocoPhillips by buying at the top of the oil market. It just goes to show that no one's immune to bad investments. So, what's the takeaway here? Always do your homework, trust your gut if something seems off, and remember that if an investment sounds too good to be true, it probably is. Now that we've covered the pitfalls to avoid, let's talk about safeguarding your financial future. Always do your homework before investing. This means researching the company, understanding the market, and knowing the risks involved. Don't just take someone's word for it, even if they're a so-called expert. The financial world is always changing, and the best investment you can make is in your own financial education. Stay informed, ask questions, and don't be afraid to seek advice from trusted professionals when needed.